Today I'm talking about
today we're talking about audit proof in your business. Record keeping is the very fundamentals of keeping good audit proof in your business. Record keeping is the discipline of keeping track of what is going on in your business. The goal of good record keeping is to 1. Provide information that helps you make good business decisions, and 2. Meet your legal obligations to the tax authorities. Record keeping is useless if good information cannot be pulled from your records. It is important you do not fully delegate the record keeping function. You're responsible for knowing what's going on in your business, even if you have a bookkeeper. If you never look at the records or understand how it is done, it becomes easy for money to leak out your business without your knowledge. Now let us move down the different kind of records you need to keep. Let's start with cash. As we all know, cash is the lifeblood of a business. You can't run a business without cash. So there are 2 types of cash that you need to keep track of: cash in the bank and cash in hand. For some business types, there's barely any cash in hand because everything's electronically done, so they hardly have cash transition. But there's still a lot of business that really deal with cash. So how do you deal with cash in the bank, and how do you prove cash in the bank? Well, you prove cash in the bank with the bank statements and your bank reconciliation. So at the end of every month when you get your bank statement, it should be reconciled to what you have in your accounting software. If it's QuickBooks, Xero, whatever you use, make sure you reconcile. So how about cash in hand? Well, cash in hand, obviously the bank is not going to help you keep track of that, so you have to do it yourself, which means you kind of have to be your own bank. You will need a cash register to keep track of cash in hand and some kind of cash lock box. It's important you never leave the cash in the open. It's important that you count the balance at least once a week. Have a cash register where you track additions, withdrawals to cash. And every time someone puts money in or takes money out, that should be signed. And unless you need a large amount of cash for your business, go ahead and deposit your cash in the bank. It's just less headache for you. I mean, you don't want to really act as your own bank. After all, you're not in the banking business unless you're in the banking business. So be sure you keep the cash register as part of your business record, because if you have to prove cash sales, whatever you do with cash, this cash register will come in very, very handy. Now, what are your legal obligations regarding keeping track of revenue and expenses? This is the biggest one because if you have to prove something, the IRS will either have you prove revenue expenses. So you need a system in place to make sure that you follow the system to keep track of revenue and keep track of expenses. If the IRS sees you're following the system and you're very consistent, then they trust your records more. But if there's inconsistencies between your records and your system, they're like, something is not right here, honey. I'm sorry, we're going to do our own estimates. I'm basing our estimates. Here are your tax due. You don't want that to happen. You want to make sure you have a system of recording revenue and system recording expenses. So in other words, if you invoice customers, at the minimum, if you don't have a software, maybe you're just starting out, get an invoice book or use sales receipts, something that you have a systematic way of recording transactions from every customers. So what about expenses? Expenses, original copies of receipts are needed. Now, it's okay if you go ahead and scan it and throw away the receipts, that's fine. Electronic receipts are also acceptable. The bank statement is not sufficient to prove an expense. The IRS actually wants to see the receipts that the expense to back up the expense. And there's a special little rule for meals. Now, for meals, it's not just enough to have a receipt. You have to write on the receipt who the lunch was with and the purpose of the lunch. Now, let us talk about money you, the owner, puts into your business. Money you put in the business could either be capital contributions or loans. These are sometimes necessary when the business does not generate enough cash to run the day-to-day. In instances like this, it is important that the owner might need to put some money just to keep the business going. When this is done, the business owner needs to specify, is this a loan I expect the business to pay? Or is this a contribution to the business where, well, I'll get my payments back in dividends and when I share my shares in the business? So you need to specify that. Capital contributions. For the capital contributions, you better make sure you document that in your annual meeting. It should be in your agenda and your meeting minutes. Also, the system or the occasions that give rise to capital contributions should be well documented in your operating or shareholders agreement or bylaws, depending on your structure. It's important that when you have capital contributions, you have a log which you give to your bookkeeper so they know when they see contributions coming, not to classify it as income. This is a very common mistake. For S corporations, contributions play an important role in determining if any gains should be recognized on distributions, because you cannot take more than you put into your business. And when you take more than you put into your business, that's a gain. And that is taxable. So now let's talk about if you put in your money and you want it back. This is a loan to your business. Be sure to drop a loan agreement, and just like the contributions, document that in your agenda and minutes in your meetings. And don't say because you're a sole shareholder you don't have to have minutes. When you formed your corporation, that was kind of a contract you formed with your state. So you are expected to have this minute if it's just you. But I do recommend you do this with your accountant in attendance, so it's just not you having this meeting. And be sure you have a loan agreement and systematic pay back the money with interest. If not, the IRS can say, well, this is not a loan to the business. You have to be very systematic about it. It cannot be random. Now, let us talk about money you, the owner, get out of the business. Money you, the owner, gets out of the business can either be paycheck, distributions, loan repayments, reimbursements. The personal expenses part is kind of mixed up with the others. I just wanted it to have its own line item because it's someplace I see a lot of problems, so I want to talk about it separately. So, paycheck. Paycheck is one way you can take money out of your business. Now, if you're a sole proprietor, this does not apply to you because you don't have to be in payroll. But as S Corp, C Corp, LLC taxes, S Corp, or C Corp, you do have to be in payroll. You have to pay yourself before you can actually take distributions out of your business. Another way you can take money out is through distributions after you're taking money through payroll. Now, if you're a sole proprietor, this is owner's draw. If your corporation is dividends, and corporations kind of have the sad thing where they get double tax on their income and dividends. So it's kind of double taxation. But you know what? Even with that, with a lower tax rate, it's still a better deal for some people. So distributions are more like reward the business owner gets for running a profitable business. So guess what? If you don't have profit, you don't have distributions, because distributions can only come from profits. It's a reward for profits. Distribution should be done quarterly, semi-annually, and annually. Distributions is not, you don't just take money out of your business just because you feel like it. It has to be systematic. You have to remember, when you form a corporation, you form a separate entity. The business is one entity because when you went to the Secretary of State and you signed that paperwork, guess what you did? You gave birth to a baby, and that baby is his own person. And just because you kind of control that person does not make you the same as the person. You still have to keep things separate, and what you do for you is for you, and what you do for the business is the business. So you can't just treat your business as a pocketbook. When you have distributions, you have to make sure this is documented in your meeting. It has to be declared, and you have to go through some formal processes for doing that. You just don't get into the habit of taking money out of your business randomly. Bad habits lead to bad solutions. So, if you want better cash management in your business, the systems actually make it so much easier to manage your cash. Loan repayments, we talked about putting money in as a loan. So the loan repayments is another way you can get money out of your business, plus the interest. That's a little extra that you have. Obviously, the interest is taxable, so don't think it's free tax-free money. Reimbursements, if you accidentally write a check from your business or you write a check from your business, you can be reimbursed. Or if you use your personal vehicle for errands for the business, you can reimburse yourself using the standard mileage rate. You have to make sure that you have an accountable planning reimbursement plan in place, because this protects you. We'll talk about that in another session. Now, personal expenses. Like I said, personal expenses is kind of wound up in the other parts, but I wanted to have it on line item because this is an area I see a lot of people get themselves in trouble. Like I said earlier, the business is a separate entity. So when you have personal expenses for your business, if you use your business for personal expenses, what can you do? Now you've done it. So how can you, what do you do? Well, you can treat it as part of your payroll expenses. That's one way. You can treat it as owner's draws if you're a sole proprietor. As a matter of fact, if you're a sole proprietor, a lot of these things don't really apply to you because you're not really separate from your business. It's just one. You can treat it as distributions. It's not recommended, but if you have to, just don't do it too often, because what can happen is the IRS can recharacterize this as income, as payroll, and then you're subject to payroll taxes. You can treat it as dividends if you're a C corporation, or this is what I recommend, just reimburse the business. Just write a check to the business and get it done with, and that way you cover it. And also, if you're going to do that, the records you need to keep. If payroll, keep the payroll records. If owners draw dividends or distribution, keep distribution and owners draws log. And if reimbursed, write good memo on the check. This is how you protect yourself. So that wraps it up for this lesson. I hope you learned something from this. I mean, you've learned how to properly keep records for cash, for expenses and revenues, money you take out of the business, money you keep in the business. Next, we'll learn how to properly categorize stuff as expense and assets, and how to keep the good records. This is an area of confusion, and we'll learn how to properly do that so you protect yourself. We'll also learn another biggie, which is someone you hire, are they an independent contractor or employees? Where's the difference? Because if you wrongly classify, that's a place you really expose yourself to audit risk. What about the video 3? Policies you should have in place to protect you. And then we go down to 4, how to properly conduct your annual meeting. You don't want to miss any of this series because you need to protect yourself as a business owner. You never know when the time comes when you might have to prove something to the IRS. So please don't miss any episodes, and I hope to see you in the next video. If you want free access to the course you saw in this video, go ahead and click the link below. The link will take you to this page where you can access the course, Audit Proof Your Business. And in this course, you get access to all the slides you saw in this video. Like what you see? Go ahead and click the subscribe button on the very bottom of this video. I look forward to seeing you in future videos.